I'm Ross Overline. I am the CEO and co-founder of Scholars of Finance, and we are absolutely thrilled to have you with us today for joining us for this national speaker series for this season. We are fortunate to have Sheila Bair, the 19th chair of the U.S. Federal Deposit Insurance Corporation, the FDIC, joining us today to share her story of how she helped lead our country and the world in part through the 2008 financial crisis. It's especially exciting for us as courage is our value of the month for November at Scholars of Finance. And Sheila is a leader who is known for the courage and bravery that she demonstrated through the crisis and throughout her career. As always, for the first 25 to 30 minutes, Sheila and I will share a candid discussion centered around her work and her values. And for the second half of this discussion, this call, we'll open up to Q&A from our students on the line, all of you here with us today. If you are able, we encourage you to turn your camera on so you can speak with Sheila directly, because we'll also take a group photo at the end today. And also, please mute your mic and be prepared to unmute to ask questions during our Q&A. If you have questions come up while Sheila is speaking, feel free to write those down to ask once we open up for Q&A, or you can even use the raise hand function in Zoom to enter the queue right away so you're first in line once we get to Q&A today. To get us started, I want to share a bit more about Sheila. Sheila Bair has had a long and distinguished career in government, academia, and finance. Twice named by Forbes magazine as the second most powerful woman in the world, she is perhaps best known as the chair of the Federal Deposit Insurance Corporation from 2006 to 2011, where she steered the agency through the world's worst financial crisis since the Great Depression. To put that into perspective, as of March 2020, there was $14.4 trillion in domestic deposits at FDIC insured banks. Sheila's a former finance professor and a former college president, and has been nationally recognized for her innovative initiatives to make college more accessible and affordable to all students. She's also a frequent commentator and op-ed contributor on financial regulation and the student debt crisis, as well as author of the New York Times bestseller, Bull by the Horns, her 2012 memoir on the financial crisis and her role in that, stewarding us through that. She's a founding director of the Volcker Alliance, established by former Federal Reserve Board Chair Paul Volcker to build trust in government, and is the founding chair of the Systemic Risk Council, which advocates for financial stability. Sheila, thank you so much for joining us. It is such a pleasure to have you with us today.
My pleasure.
Awesome. Sheila, to start us off, why don't you start by sharing a bit about your story and your time at the FDIC?
Oh, okay. Well, thank you, Ross, for that. That was a very nice introduction. You know, I used to work for Bob Dole, and he would always have an opening joke when you get an introduction like that. You might as well just sit down and take the applause because the expectations are elevated at that point. But thank you; it's very kind. You know, I've been in government service most of my life, not all of my life. I was in finance too. I worked for the New York Stock Exchange as a senior executive for many years, and I've been an academic as well. But most of my career has been in government service. And I was actually the assistant secretary for financial institutions in the early 2000s when we had the terrible 9/11 event. And then later we had the Enron failure, which was somewhat disruptive. So it was a very eventful year that I had at Treasury. I was the first wave of the George W. Bush administration. I am a Republican. A lot of people find that surprising, but I am a Republican. And you know, it just got to be a bit much. And so I decided, my husband and I decided, I spent the first couple of years with the Bush administration, and then I had small children at home, and it was a 24/7 job. You know, when the Bush people first called me, they'd assured me it was going to be a 9-to-5 job, that my biggest challenge would be to decide whether banks should be able to own real estate brokers because we had the banking policy portfolio is in the financial institution section, which is where I was the assistant secretary. So of course that turned out to not be the case when we had 9/11 and then Enron. There was a lot of work that needed to be done. It was important work, and I was glad I was there at the time to contribute. But once we got through those crises, I left for Amherst, Massachusetts, became an academic for 4 years, which was a much better balance work life. And then, of course, I got a call from the Bush personnel office again, asking me if I would come back and chair the Federal Deposit Insurance Corporation. They had the gentleman that had been chairing it had decided to step down. He was a lifelong banker. Just being a regulator wasn't his cup of tea. And they had an acting director, a guy named Marty Gruenberg, a dear friend, but a very liberal Democrat. And it was an awkward situation to have the Bush administration having, this chair of a fairly major agency with someone with political views so different from the White House's. So they asked me if I would come back and take it. And there again, they said, it's going to be a 9-to-5 job. Your big issue is going to be whether Walmart should be able to own a bank. That was the big issue at the time. The FDIC had a special charter called an industrial loan company charter. And the big issue was whether Walmart should be able to get this charter. That's ILCs are a small carve out. The general rule is commercial entities cannot own banks, but ILCs were a carve out to that. And Walmart wanted to get into banking. And as you might imagine, community banks and others were quite upset about that. So I decided to come back and talk with my family. And we decided, okay, it's time to come back. Going to be another 9-to-5 job. We're going to deal with this Walmart issue, but it hasn't been a bank failure in 3 years. Insured deposits, that's a pretty straightforward business that this agency has, an important one to the public. And of course, 6 months later, actually it wasn't even 6 months later, that was in June of 2006. We were already seeing problems in the housing sector, and it was something I was somewhat familiar with. Actually, when I was at Treasury, I had tried to work with Ned Gramlich, who's now deceased, but he was a governor at the Federal Reserve Board and had the consumer portfolio. And in the early 2000s, we had seen these really abusive loans being made in minority neighborhoods, primarily by, housing contractors. They were kind of perimeter players. They were terrible loans. They had payment shocks. They had negative amortization. And we had worked with trying to get some standards around that. There were no national mortgage lending standards at that point. The Fed actually had authority to write rules, but for whatever reason, Alan Greenspan and his successors, they kind of market oriented. They didn't like regulation a lot. So we at Treasury had tried to push standards, then we had tried to push voluntary best practices and had not been successful, but it was still a perimeter business. But when I got back to the FDIC and my economists were already looking at this, we'd realized this kind of really not very nice form of mortgage lending had gone mainstream. And of course, then we later had the subprime mortgage crisis. So it wasn't too far into my tenure. So I always joke I really should stay out of government because something always goes bad, but it seems like when I go in. But hopefully I'm there to make a contribution and make a difference. And we worked hard. We were early on saying this is a problem. There were people, I think the Fed was still saying, not going to be a problem. Housing problems are regional. You never have national problems. Mortgages don't default. That was the traditional wisdom. That's why all these bad mortgages are being made, because the traditional wisdom was, well, mortgages don't default. Well, and that was true for your traditional 30-year fixed rate mortgage. But that's not, of course, what was being done with these subprime mortgages. And so not only that, but they weren't documenting income. There's a lot of fraud. Mortgage brokers just filling out forms for a lot of these borrowers didn't even know they had these kinds of mortgages, didn't understand them. And then we had a good segment of mortgages that were not owner occupied. They were flippers, they were speculators, and again, nobody was verifying income. They were all being securitized, which means you're finance people. So I assume you're familiar with securitization. That means they were being bundled up and broken into securities and sold off to investors. Rating agencies, everybody was in on the game. Everybody was taking their cut. The rating agencies were giving them all AAA ratings because theoretically they were tranched so that the first loss position, the people buying the AAA, the very highest rated tranche of these securitizations would be protected from the lower parts of the waterfall. Other investors, equity investors taking first loss positions. That all turned out to be nonsense. When all these mortgages went bad, they all went bad and everybody started taking losses. So that was, it was a very momentous time. And we had a lot of problems. We hadn't had any bank failures for 3 years. And then I think we closed about 365 banks when I was there. And then of course we had a lot of the very largest banks were also failing. They were bailed out. So we had some pretty unpleasant tasks to do to bail out some of these institutions that really had caused the problem. But it was either that or let them go down and have a disruption to the credit availability in the economy. And I had disagreements with my colleagues, and we can talk about that. I know courage is the theme that you all wanted to focus on. And I think that's a great theme, because there were a lot of moments when I had to make decisions that were not always popular. I know one essayist for the New Yorker wrote a profile of me, and he called me the skunk at the garden party. But we did try to push back sometimes. I think I was more concerned about homeowners than I was about banks. I think banks are a means to an end. Financial services is a means to an end. We use banks to get credit flowing into the real economy, and that's good, and they can and should make a profit off of that. But the government support we provide, the charters, the deposit insurance, the Fed facilities, those are done to benefit the public, not to benefit banks. So there was a philosophical difference, I think, with my colleagues in discussing a lot of the bailout measures that we took during the great financial crisis. So we can talk about that in more detail. But I do think that it's important, even more important now, because these are not binary choices. I'm a market person. I believe in markets. I think markets properly overseen will achieve good outcomes, moral outcomes, if you will. But you need to make sure the incentives are aligned. And so if you reward bad behavior, you have a misalignment of incentives, and that's some things. So I think the government should be very, very cautious when it intervenes to bail out institutions that have been mismanaged. And so we did that a lot during 2008 and 2009. Unfortunately, I think we're doing it now. I think we're going a bit farther than we need to stabilize the economy from this terrible pandemic. And there are some parallels, and perhaps we can talk about those later if those would be of interest. But anyway, I had a good 5 years. People say I had a good crisis. I don't think anybody had a good crisis, but the agency did perform well. I actually, not only did we stop bank runs, but people had such confidence in the FDIC and the value of the FDIC guarantee. The deposits actually dramatically increased while I was there. That people, it was a flight to safety. They had confidence in us that we would protect them if their banks failed. And that made me feel good. I think my first priority in public service, in all government jobs I've been at the CFTC, Treasury, FDIC. I think if you keep your eye on the public interest and make your decisions based on what will provide maximum benefit and protection to the public, you will end up making a very moral and ethical choice as well. And that was always my lodestar. And I think overall, the agency performed pretty well. But it was quite a time, and it was very tense, and we didn't always agree. But I'm glad I was there when I was there to help stabilize the system. And I'm just so pleased now that Ross has this group of young finance professionals, young people who aspire to finance, who want to learn about ethics and make sure that they do make the right decisions when they become financial executives, because finance can do a lot of good for the country. A properly made loan can be a win-win for everybody. But you need to make sure that you're responsible to your customer. Your customer understands what he or she is getting. They can afford the loan. And there's no tricks and traps involved for them. So Ross, why don't I start there? If you'd like to drill down into any of those aspects of my tenure at FDIC or otherwise, I'd be happy to get into that.
Absolutely, Sheila. During the great financial crisis, the TARP bailout program authorized more than $700 billion to stabilize the firms that were in trouble, right? These banks deemed too big to fail. And even with that aid, more than 8 million jobs were lost in the Great Recession, right? In the years following. The consequences were absolutely devastating for the world and sparked a great deal of debate about how it all happened, right? The focus on your book, Bull by the Horns, in part. Right. Would love to hear more, in your opinion, what were some of the ethical issues that finance professionals faced in the lead up to the 2008 crisis that you think are particularly relevant for young finance professionals today? What were some of the things that were happening, and some of the things that the people on this call should be looking out for in their own day-to-day?
Yeah, it's a good question. I think because, as I said, one of the reasons this got so out of hand and the government didn't step in with standards and better regulation was there's this assumption that mortgages never default. And the reasons in the past mortgages never defaulted was there tended to be a personal relationship between the lender and the borrower. And the loans were retained in portfolios. So if the loan became non-performing, the bank, the lender or thrift institution would take the loss. And so there was an alignment of incentives, and bankers thought of their borrowers as people, as households, who have incomes and expenses, and what can they afford, and that kind of thing. So that's how it used to be in the good old, the Jimmy Stewart days or whatever. And then of course that changed. Mortgages became commoditized through securitization, and all of a sudden borrowers just became data points. They were numbers on a spreadsheet. They weren't real people anymore, and you severed that tie, that long-term relationship between the lender in terms of being invested in that borrower performing on his or her loan, because the lender would take the loss. You lost that. So these mortgage originators, and they were very lightly regulated at the state level. We joke, people going from selling high fives to refis because pretty much anybody could get into the business, and there was a lot of money to be made. And it was just a volume driven business, and they would just make as many mortgages as they could. And then they packaged them off and sell them to a securitizer. And the securitizers weren't looking either, because they were just bundling them up and turning them into securities. And then they were being sold off to investors. And so the financial professionals involved in this were no longer thinking about borrowers as individuals and households who could be hurt by a loan that they couldn't pay back. And they really, and there was no alignment of incentives because they weren't going to take any losses. So it just became a volume driven business. And the financial incentives drove into that. I mean, everything was front loaded. And the irony was how upside down things were. The mortgage originators that were, the starting point for making these terrible loans, the higher the yield on that mortgage, the more they were paid. So they actually wanted people with distressed credit scores. They wanted high credit risk, because if it was a high credit risk, they could charge a really big interest rate. And the securitizers and the investors loved those high interest rates. So we lost the human element of the face of households who were taking out mortgages to live in their homes. And the financial incentives created very skewed incentives to just do volume and not really care whether they could pay the mortgage back or not. I also think that, let me tell you an anecdote about, these are the kind of people you don't want to be. Okay, so when I came to the FDIC in 2006, by the end of 2006, I was pushing hard for mortgage lending standards, at least for banks. So we didn't have the authority to do lending standards for everybody, banks and non-banks. We only had authority over FDIC insured institutions, we and the other bank regulators. But we said, okay, at least for regulated banks, most of this is doing outside of banks, but at least for banks, let's have some lending standards. And oh my goodness gracious, a group of mortgage bankers came in to me, I think it was January of 2007. And it was, it was an intimidation meeting. So you have these a lot in Washington, where when lobbyists are unhappy with a government official, they'll bring in hordes of people and all sit around the table, and look firm and look upset. And so we had one of these. There's this huge group of mortgage bankers.
Uh-oh, our first technical issue on a national speaker series. Hey, Sheila, can you hear us? Oh, no. Hold on, everyone. I'm just texting Sheila right now. Do you want to dial in? I suppose this was bound to happen at some point during our national speaker series. We were bound to have an exec lose their connection on Zoom. So everyone, it's good to see you. I will try to entertain you for the next 2 or 3 minutes as Sheila gets back on. Hello, Sheila.
Sorry, we've got a bad storm. I'm out in the country.
No worries.
Anyway,
I know you're back.
right. So I was talking about all these lobbyists who were saying, you can't tighten lending standards, is going to constrain credit. And they said the reasons delinquencies and defaults were going up was because people just didn't care about paying their mortgages anymore. If they had to buy a washing machine, they bought a washing machine instead of making their mortgage payment. And I said, well, maybe if their mortgages were affordable, they wouldn't have to make those trade-offs between washing machines and mortgages. But anyway, there's fierce opposition to it. We did finally get tougher mortgage lending standards by early summer of 2007. It was too late by then. The horse was out of the barn. And so I shifted to tactics and started calling for modifying the loans that had already been made to convert them from these adjustable rates into fixed affordable wages, fixed mortgages at affordable rates. And that turned into a firestorm of criticism as well. And so I was giving a speech in New York, say October of 2007, to a bunch of mortgage professionals. And I kind of put it to them and I said, look, we need to get these mortgages restructured. We've got this wave at this point. There was a wave of foreclosures. It was putting a downward pressure on home prices. It was starting to hit the economy. And when I was finished, they were all upset. And when I was finished, a hand went up in the back of the room. And he said, oh, no, he said, you don't understand. He said, you can't give these people, I called them these people, a break on their mortgages. If you give these people a break on their mortgage, they'll just take the extra money and go out and buy a flat screen TV, right? The proverbial flat screen TV. So I said to him, I said, well, if that's how you feel about these people, why did you make the mortgage to begin with? And you know what he said to me? He said, bad regulation. It was all my fault. So 9 months before, they were fighting like hell not to get a tighter regulation. And then they were blaming the regulators. So this was a mindset that had set in, this entitlement thing. We can make money however we want to make money, and we don't care who we step over and abuse. And then when things go bad, we're going to blame it on somebody else. I think that is a toxic culture. And one that I think, unfortunately, was somewhat pervasive in some of these securities firms that were feeding the securitization machine. And I think we've cleaned a lot of that up now. The regulators have emphasized culture. New leadership has come in, and compensation incentives are better now too. You don't have these front-loaded, securitization deals, and derivatives were another problem where all the compensation was front-loaded. So we've changed the compensation incentives and have better regulation. I think we're in much better shape now. But yeah, that was the culture around in a lot of firms back then. It was pretty shocking.
Wow. Yeah. Thank you for sharing the story. And I'm sure that all of us are just as shocked. It's a bit jarring to hear.
Yeah. But that's good that it's, back in 2006, it wasn't. now it's like, everybody understands that's not acceptable.
Right. I think hearing that reminds us, all of us on this call, why we're here, why we're on this call together. And it actually, I think, segues really well into the last question I want to ask you before we open it up to Q&A with our audience, because I want to make sure everyone here on the line gets as much time with you as possible. In an interview that you did with PBS several years ago, you talked about speaking up throughout the crisis, before, during, after, and you actually brought up a story when you went into a meeting with Ben Bernanke, Hank Paulson, Tim Geithner. So they were essentially asking the FDIC to stand behind all of the liabilities in the financial system, and you pushed back on many aspects of the TARP bailout, of the structure, right, of the bailouts. For instance, banning bonuses for executives at the firms that partook in the risky behavior leading to the crisis.
Right.
For all of us, we hear that, we think, yeah, okay, you're banning bonuses for these executives at the firms that are responsible for the meltdown of our economy. That makes complete sense. But somehow you found yourself in a room with a number of leaders who were pushing back on that and thought that these executives should still be able to take their bonus. It's one example of courage, when you demonstrated courage in your career. And I wanted to ask you maybe to share that, talk about that story or another story where you demonstrated courage, and really hear from you what courage means to you and what it looks like in action in finance.
Yeah. Well, thank you. And I have thought about that a lot because in the notes you'd sent, the students wanted to talk about courage. And, I think I was honored to receive the Kennedy Library's Profiles in Courage Award. And so that was, and they had a very nice write-up about how courageous I was. And, when I gave my acceptance speech, the irony was I didn't I didn't know I was being courageous at the time. I think we just did what we thought was right. We just thought what we did, it was just common sense. And I think if you have a conviction of purpose, if you know what you're doing is right, if you know what you're doing is worthwhile, it's got moral content, it's going to help people, it's the right policy, it's right for your firm, whatever, then you can have a singular focus and commitment that, and maybe I was just happily ignorant with all the people around me I was making unhappy, and I apologize to them if I did, but I really just didn't stop and think about it. I didn't think about myself as being courageous. I thought about myself as doing something that was right. And we focused, that was, yes, I did take on the banks. I thought we needed more accountability. It was a disgrace that they were, after getting these massive bailouts, they were paying themselves bonuses again by the end of 2009. It was just terrible. And a lot of other leaders, John Reed, former CEO of Citigroup, a lot of other, former Wall Street CEOs spoke out against that. It was really bad. And so that was one area where I did try to put my foot down and stop a lot of these bonuses where I had the power to. But with the Kennedy Award, it was really more our advocacy for helping homeowners because that was not popular. A lot of people just didn't think it was going to work. It was just too hard. It was a lot easier to bail out banks, right? Write a big check for a bank. That's easy to do. Try to get these mortgages one by one, the owner-occupied ones, modified with a lower payment to keep people in their houses. That was hard, but that was worth doing. And I did antagonize some folks, and more than I was aware of at the time. Later, when I read some of these books, that I realized, whoa, they were really upset. But it was still the right thing to do, because again, finance, and I hope you think about this in your careers. Finance is a means to an end, right? And it can be noble. It can have a high moral purpose if done right. Because access to credit, access to wealth management, access to low cost, financial services, credit cards, payments, deposit accounts, those are all things that people need day in and day out. And if it's done in a way that's simple and cost effective, you can make people's lives better, and you can make a fair profit for your firm as well. But never lose. That's your end game, right? That's your end game. You want to benefit your customer. And if you do that, you're going to have a long-term relationship that is going to serve the long-term interest of your financial firm well as at the same time. But don't lose sight on that. I think when people start looking at their own, how much is my bonus going to be this year? You look at what happened at Wells Fargo. Oh my gosh. And there again, so much of this is compensation driven. And that's why as future leaders and managers and executives of these banks and firms, make sure you have a compensation system that is aligned and rewards ethical behavior. And again, the lodestar for ethical behavior is helping your customer, doing the right thing by your customer. If you have compensation incentives that will give them, reward them for confusing their customers, for giving them products they don't want or need, you're eventually going to have a trouble. Wells is once a great franchise and will be again. I'm sure they're cleaning up the mess that they had, but really it's hurt their business and it's hurt their reputation in a way that I know they deeply regret.
Thanks, Sheila. I really appreciate the perspective, both on your own time there. I found it really interesting that at the time you didn't think you were being courageous. You just thought you were doing what was right and made sense. Right? You mentioned common sense in the spirit of serving customers, serving people. You talked about earlier, right? Who had lives, who had paychecks, who had bills to pay, miles to feed, et cetera. One thing I'd love to ask, and one more question actually, then we'll move to Q&A. For everyone here on the line, feel free to start using the raise hand function to get in the queue after this. We'd love to ask for the students on the line right now, right, who are sophomores, juniors, seniors, maybe who are entering their career, right, as a first-year analyst, second-year analyst, or even early career professionals who might be joining us on the line today. What are some of the ways that you think they can start being courageous now in their day-to-day lives in a way that sort of builds that muscle, right? So that, 5, 10, 20 years from now, when the stakes are so high, they have the character to do the courageous thing. They have that courage to do the harder thing.
Right. Well, that's a good question. I mean, I think lot of that will depend on the career path, the entry job that they have. Ironically, a lot of entry jobs in financial services are customer interfacing. So maybe, maybe you'll have some early opportunities. But there again, I mean, and sometimes some firms this might require courage. But if you're not sure about a product, or a securities firm suggesting, recommending a certain investment to retail customers, if it doesn't sound right to you, if why would this be appropriate or suitable for my customer? I think raising your hand and pushing back a little, I think is what you need to do, and that takes courage. It does, but I actually think you will earn the respect of management by doing that, because at the senior levels, at least, they get, most of them, not everybody, but most of the people who get to the senior levels have gotten there because they do have an ethical core, and don't engage in the high risk stuff, and don't engage in the edgy stuff that can hurt your reputation and hurt them. So I think you'll actually I think people will respect you if you raise your hand and say, I'm not sure that's right for our customers, but we should really think about that. I think those are the kinds of things you should be prepared to do. And, the thing about sticking your neck out a little bit, I will say, make sure you're prepared though. Make sure you completely understand the point you're making, and that you have a good case to make when you do raise your hand and provide that pushback, because there may be something you don't understand. So you want to make sure you've got a clear picture of your argument, and you want to make sure your argument succeeds. And especially as a new person with a firm, people will not always view you with the same gravitas as someone who's more senior, has been there more often. So do your homework and make sure you know what you're talking about. That's always a good idea for any endeavor. But do speak up. You don't think it's helping your firm's customers, say something.
Excellent advice, in my opinion, Sheila, to do your homework and be prepared to defend your position when you are being courageous and you are stepping up and standing up for your customers, for doing what's right. And I see we already have a queue of questions building up, so I'm excited to turn right over to Q&A from the audience today.
Okay.
Once I'll invite you in to ask your questions, everyone. Just introduce yourself, which university you're coming from. You can say hello and ask your question. David, I see you're first in line, so we'll start with you.
Thank you. Hi, David Laird. Thank you for coming on, Ms. Bair. I actually currently work for the FDIC. So
oh, great.
I'm gone through some of the training programs that I'm sure you had a hand in forming
Yes.
when you were chair
great.
years ago. So I a lot of interesting questions that I'd like to ask. I'll try and prioritize. One of them, you were recently named the chair of Fannie Mae, as I understand it, of Fannie Mae. Yeah. And so I'm kind of curious what you think. There's been a lot of discussion about potentially re-privatizing these massive entities.
Right.
And I'm curious, you don't have to tell me your opinion on it, because I'm sure that's probably a conflict for you at the moment, but we're kind of getting to the ethical question of this financial decision. What is the sort of foundational set in stone criteria that if it doesn't fulfill this, I will not make this ending choice? And if you want to be really generous after you answer that, could you also please give me your opinion on the OCC going solo with the Community Reinvestment Act?
Oh yeah, well, that was a bit troubling. So I would say Fannie, Freddie, chartered banks, any institution that has a government charter, has a government backstop, has a government mission, a public mission. I mean, that's kind of why you exist. So first and foremost, and we saw this with banks, we saw this with GSEs, it is still true. If you're not operating in a safe and sound manner, if you don't have good risk management, a strong base of capital, and reserves to absorb losses, you can't fulfill your obligations for that public mission. And the reason we provide these public backstops is because we need institutions in our financial system that can function through the cycle, right? So anybody can make money in good times. That's not hard. The problem is when things get bad, loan losses start to mount, you still need a functioning financial system. And in 2006, 7, and 8, we let banks deplete their capital. We weakened capital standards because of the FDIC. It was more in the investment banking side than commercial banking side. We were able to keep standards somewhat stronger, but that they were engaged in high risk activity and they had too little capital, and that's why the system was disrupted. They had to get bailed out, and that's not why we have banks. There shouldn't, and institutions should never have an entitlement attitude towards the FDIC. They're right. They don't have a right to deposit insurance. That's something that Congress has given them. Taxpayers back it. They have an obligation that goes along with that. The same with the GSE, taxpayer backstop with access to the Fed liquidity facilities. Your government charter gives you certain responsibilities, and first and foremost, you need to do that in a safe and sound manner. That doesn't mean you can't make a good profit too. You can, but there again, I think returns on equity should never trump safety and soundness and public mission. And so, I think that's my philosophy for any type of financial institution with a government backstop. And, I think that you're right. I can't say much about Fannie, but I do think, and this is the director of FHFA. We're in conservatorship now, so that's a role I'm familiar with because I used to be, have a similar role as chair of the FDIC with failed banks. So I kind of get what the game plan is and what needs to be done. And we have a very strong proposed capital rule that I assume will be finalized soon. And I think that is the first priority, to make sure that we have an adequate capital base to continue to operate and provide support for housing finance through the cycle. That's really essential for a bank or a GSE.
Awesome. Thanks so much, David, for the great questions. I see we have Kevin next.
Hi, Ms. Bair. Kevin from Dartmouth College. So I guess I have two questions for you, much less technical than what David asked. But so the first question is, say right now, after such an incredible career, you're able to go back to your fresh out of university self. What would be one piece of advice that you would give? And the second question, much more general, is what do you think is probably the most important character for someone to have if they want to really succeed in the financial sector today and maybe 20, 30 years into the future?
Oh, boy, those are good questions. Well, just coming right out of school, I think the best advice I can give you is, well, find out find jobs that you feel have a good purpose or can be rewarding to you. That said, be open-minded. Don't try to pre-program your career. Don't, I want to do this and this and this. I've seen so many people have this narrow focus on what they want to do, the kind of job they want to have, where they want to go next. And they've just totally missed other opportunities. And a lot of it you can't control. I mean, the economy's not so great now. Maybe in finance, I think there are probably still some pretty good opportunities. Obviously, in other sectors, there are some challenges. And so, you need to maintain flexibility because you don't know what the economy is going to bring you when you're ready to jump into the labor force. So be open-minded and be flexible. And then when you take the job, focus on doing that job well. The other thing that I find young people do is they're ambitious, and that's good, but they're always looking to the next opportunity and not focusing on what they're doing. And do whatever that job is. You might have to take a job that's not the greatest job in the world in terms of your aspirations, but do it well. And if you do it well, you're going to be noticed and you're going to get promoted, and you're going to word's going to get out about you that you're conscientious, you're professional, you're, collaborative, productive, all the things that employers look for employees. So I think that's the kind of mindset I would have coming out of school. And in terms of the long-term question, 20, 30 years, get to know technology. Technology is going to disrupt financial services. I advise a couple of blockchain companies. Blockchain has gone mainstream, I think, in the payment system in particular. It's been slow to be accepted, but once it happens, I think it's going to happen very rapidly. And firms, a lot of financial functions now, there's going to be a lot of disintermediation in the financial system. Payments is a prime example, where with blockchain, you can be, payments directly from point A to point B. You're not going to need a bank intermediating it. So that's going to happen. And so I would say, and just, robo-advising, asset management, everything is going to be disrupted by technology. That said, we're always going to need a human element. And, I think using technology, for instance, in AI to underwrite loans, I think that has some advantages in terms of, computers presumably are race neutral and gender neutral. So you certainly wouldn't have conscious bias with a computer. That said, these algorithms are only as good as the data that you're putting into them. And if there's bias in the kind of data you're feeding in, you're still going to have bad results. So I think having that human overlay is always going to be important. So I don't think technology is going to replace us all, but I do think it's going to really change the way we do business in the financial services sector. But I think that's going to be good. It's going to lower costs. It's going to create new kinds of opportunities. But yes, be on top of technology because big changes are coming.
Sounds good. Thank you so much.
Sure.
Thanks, Sheila. And Kevin, excellent question. I'll second that. Ryan, I see that you're next to mine. Would love to hear your question.
Sure. Thanks, Russ. Hi, Ms. Bair. Thanks so much for taking the time today.
Sure.
I'm I guess, an alumnus and co-founder of Scholars of Finance, so very grateful for your time today. And for context, I work in equity sales and trading, so I have the pleasure and the joy of working in markets.
Good.
I have an opinion which doesn't get me very far with friends, and so I'll sort of phrase this as a question, but you sort of touched on regulation or lack of regulation leading up to the financial crisis and housing markets. And so my question is who in either government or financial institutions should have a comprehensive view of the whole system, sort of end to end, and be the one to place a stop at one of those links? And I guess I'll share my view is that, you know, I'm incented to do right by my client, but I don't think several links down the line. And so I guess my view that is not popular is that no one was really incented to look really broad enough.
Broadly,
But curious of your thoughts.
Yeah. Well, I think that's right. I think that's still true to some extent. We have, it's frustrating to me. I think Dodd-Frank, which was the financial reform law enacted after the crisis, created something called the Financial Stability Oversight Council, which is comprised of all the major regulators. And it also created something called the Office of Financial Research, which was supposed to be, the idea was, at least I understood it, would be to collect data from all the different regulators we have and you know, put it in consistent formats and be able to analyze it across these different silos we have in regulation to get a holistic picture, and that the FSOC itself would have ownership of the system as a whole. I don't think it's worked out quite that way. I think the Fed is still really dominating a lot of the system stability analysis, and they're great. They have really smart economists, but they're highly bank centric. And I don't think they have as good a sense or expertise or understanding of what's going on in equity markets, for instance, that the SEC would have, housing that finance, which FHFA would have. So I'm not sure we have that holistic view now. I think that the statutory tools are there to do this better. And I'm hoping the Biden administration, this is why the Treasury Secretary is going to be so important. I think having somebody with the financial market understanding and expertise, because I think FSOC does give us the tool to look at this more holistically, but we're not doing that. And you can just see now, so the banks are knock on wood, much better than they were during the current financial crisis. Let's put it this way, a lot more capital, better liquidity, but there's a lot of leverage outside of the banking system now with private equity, hedge funds, insurers. They're outside our prudential framework of regulation. And that poses risk. And some of it already blew, money funds blew up again. The Fed had to bail them out again because we didn't get that fixed. That's a prime example of a non-bank function. Even though it's a non-bank, non-regulated bank entity, it's still providing basically, banking functions in terms of having on-demand redemptions, but investing in more complex, longer-term assets. And so that model's, you need to have some capital behind that, or that model's going to fail, and it did fail again. So it's really a good question. I think FSOC provides the tools. I think the Biden administration will be really focused on this right now because there are a lot of risks that have migrated outside of banking that we're just not dealing with. That's a good question.
Anything you wanted to add,
Thank you
Ryan?
so much. I guess, well, yeah, if I could ask a follow-up,
Sure.
There's been a lot of fear of, risk moving into the non-bank or shadow banking world. And
Right.
I guess my view would be that the risk has to go somewhere. And so maybe better off to hedge funds specifically set up to warehouse that risk. But maybe separate from that is, do you think like the COVID crisis, the banks sort of look like the heroes, that they've stood really strong? Do you think that the public perception over the banks I don't know, public PR or credit worthiness will turn around. And, you know, the banks have been one of the bright spots of providing credit and access to liquidity for companies in every single sector, compared to being the 1-6 sector in the recession.
Right. So, you know, I don't necessarily think, let me just start on hedge funds, that we need prudential supervision around hedge funds. I do think we need better transparency. Some of their trading practices have, you know, been implicated in disruptions in the treasury market. You know, maybe the answer to that is having centralized clearing in treasuries. You know, I think there are ways short of, because you look, I'm a markets person, and a hedge fund, you know, that's can fail without having systemic ramifications. Let them go down. That's what they do. They make a lot of money, they lose a lot of money, and that's fine. So I don't really have a problem with that. In terms of banks being heroes, I'm not going to give them heroism, because I think they're you know, I'm on record. I think they should have suspended dividends. I think the Fed should have asked them to suspend dividends until we got through this. And that's the framework. That's the capital framework. We had something called capital buffers that we wanted banks to dip into during a crisis and suspend their dividends to conserve capital and build balance sheet capability. Banks have really fought that. They did suspend buybacks. Good for them. Not so much on dividends. They did have their credit lines open this time. Thank God. That was a huge problem during the crisis. So, and I'm a corporate board director. And so, you know, the credit lines were open. Companies were able to draw on the credit lines. The Fed, of course, helped them a lot by backstopping the corporate debt market. So companies could draw down on their lines, but then they could issue new debt and pay those lines back down. So that, you know, again, there are a lot of different ways that the Fed liquidity facilities, so maybe we shouldn't label them as bailouts. Some might have indirectly helped these very large banks a lot. And just, you know, all the debt issuance, the trading. I mean, you can look, you know, their investment banking and trading operations have been huge money makers during this terrible pandemic. Those who make loans are suffering more because they've got compressed interest margins, net interest margins. They're going to have increased loan losses. So the traditional banks are being stretched a lot more than the universal banks that have big securities activity. But a lot of those profits are being generated by the Fed backstop. So I don't think they should pat themselves on the back too much. Another bone, they have done a lot better, but one more bone I would pick is with this, the Main Street lending facility. And I don't get that. And maybe you have some insights on that, but the Fed set up this facility. It only asked them to take 5% of the risk, just 5%. They were going to guarantee the rest of it. For lending to mid-sized companies, and there's just been very, very low take-up, and I don't get that, and that's been disappointing. And I've heard, you know, these banks say, well, they don't want to take the risk. 5%, you can't take 5%. That's the kind of thing where the country needs them right now, especially you know, in the medium and small businesses who cannot tap you know, public debt markets. They need credit, and so that's been a bit disappointing. But yeah, overall, they performed much better than before. That's for sure. And, yeah, good questions. Thank you.
Thanks so much.
Thanks, Ryan. Excellent question. It's good to see you here. And Sheila, thanks. I see next we have Demi with a question.
Hi, my name is Demi. I'm from Harvard College. I have a question more for the ladies on the call. What would be a piece of advice you would give to a girl, specifically like undergrad, that wants to be successful in the industry, an industry that's still predominantly, you know, dominated by men? What would be a piece of advice there? And thank you for talking to us as well.
Well, first of all, I'm glad you're looking at finance as a career. We need more women in finance. I think, you know, women, there's a lot of data research on this that shows that women, you know, everybody has individual attributes, but as a group, women tend to be a little more risk averse than men, a little more engaged in the human element, right? So, and I do think, and Christine Lagarde said this, we'd had more women in top spots during the great financial crisis. It might not have happened, because I think women tend more than men to, you know, maybe it's our maternal instincts or whatever, that we think of people, right? I think of customers as people, not data points, but as people, and a little more risk averse. So good. We need more women to balance that out. You know, you need to be a risk taker too. You can't make money without taking some prudent risks, but you need a balance. I think it's getting a lot better. I think the Me Too movement has helped a lot. There was still a lot of pretty bad behavior at some of these firms, and that's been, I think, if they don't get it, at least they're fearful now, right? So you you don't see those bad behaviors or hear about them so much anymore. But there's still some subtle things, you're gonna just have to accept that. I think you're gonna have to always be better prepared, and that's okay. Just do more homework than anybody else. Be better prepared. Sometimes you get to fight to get into the meeting, get into the right meeting. I found that throughout my career, and I was the only woman agency head during the financial crisis. And I would come into meetings sometimes, and I would just have a sense that the guys had been off someplace else and they kind of already made the decisions. And then, so this was like, I was going to get jammed, and a few times I did get jammed, and I had to push back pretty hard. So, but demand to be in the meeting and demand to have your voice heard. Another way I think women can be marginalized is lack of acknowledgement. This would happen to me on more than one occasion. They did a profile of me in Time magazine. I mentioned this experience, and I got so much mail from women who had the same experience, where we were sitting in a meeting, and you make a point, and there's like dead silence. And then 10 minutes later, some guy makes exactly the same point, and all the other guys are saying, "Oh yeah, that's right, we really agree." And he's like, "What did I just say?" So if you're in a meeting and a woman has made a point, another guy is trying to take credit for it, stand up for her. It doesn't matter if you agree with her or not. Just say, Sheila just said that. Excuse me, Sheila just said that. I think there's those kinds of ways you can help each other. And you don't have to always agree. Women will have diverse views. So that's not what, supporting each other is all about. But we can all validate our right to be heard, right to be in the meeting, right to be part of the decision making, right to have an opinion and a voice and have that factored in. So I think you'll find financial services much improved and much more receptive for women. Still some work to do, but I'm just really glad you and so the other women on the call are going into the business, because we need more women there. Good question.
Thank you so much.
Sure.
Fantastic. Thanks, Demi. But I was actually going to ask the same question if nobody raised their hand to ask something. My mother, God bless her heart, was in finance for decades and was shattering the glass ceiling back in the 80s and 90s. In the very, very early days. I very much look at her as a pioneer in gender equity in finance and her role as a stockbroker several decades ago. And so I think seeing, maybe it's just something personal to me, seeing women who have been successful in finance, who have really made a difference. It's really encouraging and really inspiring. And for all the guys on the call, I will plus one Sheila's point. I have personally been in meetings where that's happened and I've seen it. And I've been that person to say like, hey, actually, like Caitlin made that point literally ago.
Good for you. Good for you.
Yeah. And for any of us guys on the call listening to that, I've actually had people come up to me after the fact and say, hey, I actually really appreciated you calling that out.
Yeah.
It means so much to the person who didn't get called.
Exactly. Yes, it does.
Yeah.
Good for you.
Just a plus one that I've seen it happen
Thank you.
too. I was going to ask Sheila, when you think, I'll throw a question in really quickly.
Yeah.
Unless somebody else wants to jump in, we have time, I think, for one more or two more. When you look back at your college years, you look back at the early years of your career, if you had to go back and give your 19, 20, 21-year-old self one or two key pieces of advice, what would those pieces of advice be?
Yeah. I think what I said before in terms of, first of all, find a career path that you're going to find rewarding. And there are a lot of different ways, a lot of different job opportunities, a lot of different economic sectors, but make sure it's something you're going to find rewarding, but be flexible and keep your eyes open into opportunities. And then, keep doing what you think is right. And if you find yourself in a job where people are just doing things you don't agree with, then leave. It's speak up, and if you can't get things changed, then leave, and be prepared to understand you may have to do that at certain points in your career. And sometimes that can be financially challenging. That will require some financial courage. But I do think, at the end of the day, you need to live with yourself and feel good about what you're doing. So be open-minded and flexible about career opportunities that may present themselves, but make sure it's something, you're comfortable with. And most jobs, you can adapt those jobs. You can find ways. Maybe the job as it exists is you're not having a positive input benefit for other people, sometimes you can turn the job into more than what is originally presented to you. And I think it's good to think in those terms as well. And and be adaptive, because to the technology question earlier, globalization of technology is making, is a catalyst for change in so many ways. And you need to be adaptive and embrace change. Don't try to resist it. Embrace it. Try to stay ahead of it. And there again, your education is going to be important. Get a good education. Make it the most you can of your education. I actually was a liberal arts major, and then I'm a lawyer. I went to law school after that. But I found my philosophy major helped me learn how to think and adapt, and also helped me identify my moral core, and what my objectives were, and how I guided my decision making through my career. So, but make the most of your education, and whatever, you may be a finance major or economics or whatever, and those are great, but take a few philosophy courses too, and some English as well, because good communication skills are always going to be important no matter what kind of job you have.
Amazing. Thanks, Sheila. And
Sure.
with time for one last question, Aaron,
Okay.
I'll turn it over to you.
Yes, so thank you so much for the talk today, Sheila. And I'm Erin. I'm a freshman at Wharton. And it's been wonderful getting to know about you and also your experience in finance. I'm sure that all of us have really gotten to know a lot of the insights and experiences you've had over your professional career. And looking forward now, I would love to know, what are some of the things that you're looking forward to improving on yourself in the future as well, and how you really bring in your experiences to continue further improving?
Yeah, that's very sweet of you to ask. At my age, yes, I do still think about my own future development. So I just became the chair of the Fannie Mae board, and we're trying to exit conservatorship now. And I have a long history with Fannie Mae. When I was at Treasury, I had oversight on policy, GSE policy at Treasury. And then I had to deal with some of the problems that were created by some of the things that the GSEs are doing that shouldn't be doing at the FDIC. So I've got a long history about it, and I care a lot about housing finance. I care a lot about access to affordable mortgages for homeowners. I do think done right, homeownership still is a great way for working class families to build wealth. So I'm really looking forward to, as we exit conservatorship, to getting that right and staying focused on being safe and sound and mission focused. And I do believe we can do that and still provide private investors with a decent return. I love to write. I love to write for kids, actually. So I've got some new children's books coming out on financial matters. They're fun. They're rhyming prose. They're funny. I try to make it entertaining, but I do think kids get money at an early age, and we don't give them much educational information to help them, at an early age, develop just some basic money sense. And I like writing picture books in particular and I include educational material at the end, because I know parents read those picture books with their kids. And I think I reach a lot of parents too with some just financial basics by writing those books. So I've got 4 more coming out over the next couple of years. It's a series, which I'm pretty excited about. And, I still try. I don't think I want to go back into government service. A lot of people talk with me about that. I've had a good public career. I enjoy my board work, and I'm excited about leading the Fannie Mae board. But there are other ways I try to influence policy through writing. I may write another book too, a grown-up book. I think there's some things now going on with monetary policy and kind of this bailout mentality we're getting into that is harmful to morality, harmful to accountability, and we're not quite thinking through. So those are the areas where I would like to further develop at my stage in life. But that was a very sweet question. Thank you. I hope it answered it. Good luck at Wharton. It's a great school. I know a lot of the professors there. You're a good place.
Fantastic. Thanks so much, Aaron, for the great final question. And Sheila, thank you so much for joining.
My pleasure,
us
Ross.
today.
It was fun.
We
Great.
are so grateful to have had you. I'm personally really inspired to study and think more deeply about the financial system and better understand its inner workings, and understand at each point, sort of in the system, how can we be at our best? How can we be ethical and serve customers in a courageous way? So want to thank you again. It's been wonderful to have you here.
My pleasure.